It's a Tuesday morning. You wake up, make your coffee, open your phone, and the first thing you see is a news headline that says, "Markets in Freefall." You scroll down a little further. S&P 500 drops 900 points at open. Recession fears grow. Investors panic as sell-off continues. And just like that, that normal Tuesday morning doesn't feel normal anymore. You open your brokerage app and you see red everywhere. Your portfolio is down, maybe $2,000, maybe $8,000. Your phone buzzes, group chat, someone's account is down $15,000 in 3 days. Someone else already moved everything to cash. Another person is thinking about doing the same. And that quiet little voice starts in your head. Should I sell too? What if it keeps going down? What if this is the big one? This is the moment, right here. This is where most people make the worst financial decision of their entire lives. They sell. They panic. They follow the crowd like a school of fish, all turning at the exact same time. None of them thinking, just reacting. Somewhere in the middle of that chaos, there is one person who is not panicking. Not because they're rich or special, but because they built their portfolio differently before any of this happened. Today, I'm going to show you how to be that person. My name is Richard, and I teach what schools should have taught us about money. I research financial psychology, why some people build wealth almost effortlessly, while others stay stuck for decades working hard and never getting ahead. Make sure you smash that like button and subscribe if this video helps you see money differently. Now, before we get into the topic, it's March 2020. COVID just hit. The S&P 500 drops over 30% in weeks. If you had $10,000 invested, it dropped to around $7,000 just like that. And it happened so fast that people didn't even have time to think straight. Millions of people sold everything, pulled out, protected what was left. It felt like the right call, and then the market came back. By the end of 2020, it had fully recovered and finished the year up. The people who sold missed the entire recovery. They sold at the lowest prices, then bought back in after prices had already shot back up. They did it completely backwards. Their emotions made the decision, not logic, not strategy, fear. But here's where things get interesting. The people who came out of 2020 ahead weren't geniuses or Wall Street insiders. They were regular teachers, nurses, office workers who simply owned the right things going into the crash. Things that held value, kept paying income, or actually went up while everything else fell. They were already positioned before the chaos started. That's the entire game plan I'm sharing with you today. Before we go further, let me explain what an ETF is, because I'll use that word throughout this video. An ETF, exchange traded fund, is a basket of investments bundled into one thing you can buy. Instead of picking one company and hoping it does well, an ETF lets you own a small piece of many companies at once. Think of it like ordering a combo meal instead of just one item. More variety, one order, less risk. The three ETFs we're covering today are IAU, TLT, and SCHD, random letters right now. But by the end of this video, you'll know exactly what each one does and how a regular 9-to-5 worker can use them to protect their financial future. Here's what's really at stake. And I need you to hear this part. If you reach retirement age without enough money, there is no reset button. You just keep working. Tired, maybe in pain, missing your grandkids' birthdays because you're stuck behind a desk, missing the trips you always talked about, saying maybe next year again and again. That's the real cost of the wrong strategy. It's not just money. It's your time, your health, your freedom. These three ETFs aren't a magic fix. Nothing is, but they are three of the most reliable, beginner-friendly tools for protecting your money when markets get rough. And rough markets always come back around. Always. Here's something most beginners never realize. When you invest only in an S&P 500 index fund, you're 100% exposed to whatever the stock market does. Market up 20%, you're up 20%. Market down 30%, you're down 30%. No cushion, no protection, full hit every time. Put real numbers on it. You're 55 years old. You've saved $300,000 over 25 years. The market drops 30% in 6 months. Your account is now worth $210,000. You just lost $90,000 without doing a single thing wrong. And here's the part most people don't know. To get back to $300,000 from $210,000, you don't need a 30% gain. You need a 43% gain. Because losses hurt more than gains help. If you have $100 and lose 50%, you're at $50. To get back to $100, you need a 100% gain. You have to double your money just to break even. That's the math working against you. And most people don't see it until it's already happened. Now, here's the key insight that changes everything. When a crash happens, the money doesn't disappear, it moves. Like water, you can't destroy it, you can only redirect it. Scared investors don't stuff cash in mattresses. They move it into things that feel safer. And historically, 3 places receive that money every single time the market panics: gold, government bonds, and quality dividend stocks. That's exactly what IAU, TLT, and SCHD represent: fear hedge, recession play, income engine, 3 ETFs with 3 completely different jobs working together as one system. Most investors build a portfolio like a glass house, beautiful in calm weather, shatters in a storm. These 3 ETFs are the storm shelter underneath that house. You still get the growth in good times, but when the storm hits, you have somewhere safe to go. Now let's get into each one. Gold has held value for thousands of years. Through collapsed empires, failed currencies, and world wars, across every culture on every continent, gold kept its value. People always wanted it. That never changed. IAU is simply a gold ETF that tracks the price of gold directly. One share equals a small slice of real physical gold stored in a secure vault. You don't need to buy coins or rent a safe deposit box. You just buy shares from your phone in about 30 seconds, and you own gold. The numbers back this up. IAU has delivered roughly 8% average annual returns over the long term. And when fear takes over, gold doesn't slowly inch up. It moves fast. In the 12 months leading into early 2025, gold nearly doubled from its lowest point to its highest point in that single year. If you had $10,000 in IAU at the low, it could have grown to close to $20,000, not because the economy was doing great, but because people were scared and ran straight to gold. Central banks are also buying gold at near record levels. These aren't individual investors or hedge funds. These are the institutions that manage entire countries' financial reserves. When the people running national economies are quietly loading up on gold, that tells you something important about where serious long-term money is going. Think of IAU like car insurance. You pay every month, and most months nothing happens. You might even think it's a waste. But then someone runs a red light, and that insurance saves you from a $15,000 repair bill. IAU isn't there to make you rich in calm markets. It's there to be already working, already rising at the exact moment everything else is falling. That's its only job, and it does that job better than almost anything else. 2 honest weaknesses to know: gold pays no dividends, it doesn't send you cash payments, and it can drop sharply in the short term when the dollar gets strong or when interest rate expectations shift. There were periods recently where gold fell 4 to 10% in a single day. It's not a smooth ride. But inside a 3 ETF system, it doesn't need to be perfect. It just needs to do its specific job when fear takes over. And it does. Now the second ETF, this one most people want nothing to do with right now. And that's exactly why it deserves attention. TLT holds long-term US government bonds, loans you make to the US government that pay you back with interest over 20 to 30 years. The government has never defaulted on this debt. So the safety of getting your money back is about as solid as it gets in the investing world. But here's what makes TLT powerful and what most beginners never learn. TLT's price moves in the opposite direction of interest rates. Rates go up, TLT goes down. Rates go down, TLT goes up. Why does this matter? Because when a real recession hits and the Federal Reserve cuts interest rates to try to save the economy, TLT goes up, sometimes dramatically. In a deep recession with aggressive rate cuts, TLT has the potential to surge 30% or more. While stocks are collapsing, TLT could be one of the best performing things you own. Here's the honest backstory. TLT dropped nearly 48% from its peak over the last few years when the Fed raised interest rates faster than they had in decades. If you had $10,000 in TLT at the peak, it dropped to around $5,200. Brutal. Billions of dollars were pulled out. It became one of the most hated investments in the market. But here's the critical distinction. TLT didn't collapse because bonds became worthless or because the government stopped paying. It collapsed purely because rates went up fast. Rising rates and a recession are two completely different things. When the economy overheats, the Fed raises rates, that hurts TLT. When the economy breaks down, the Fed cuts rates, that's when TLT surges. Think of TLT like a compressed spring. The harder you push it down, the more violently it launches when released. TLT has been pushed down hard for years. If a recession hits, and recessions always come eventually, that spring releases. The investors already holding TLT ride that move. The ones who wait until it's already happening scramble to get in after the price has already jumped. And while you wait, TLT pays you. It currently yields around 4 to 4.5% annually. Put $10,000 in TLT today, and you collect roughly $400 to $450 a year in interest payments without selling a single share. You're not just sitting on something hoping it moves, you're getting paid every month while the setup builds. Now the third ETF, and for most people working a 9-to-5 job, this one might be the most important of all. Because while IAU waits for fear and TLT waits for recession, this one doesn't wait for anything. It just quietly works in your favor all the time in any market. A dividend is a cash payment a company sends to its investors out of its profits. Imagine owning a small slice of a profitable local restaurant. Every 3 months, the owner sends you a check representing your share of the profits. The restaurant doesn't need to be growing or expanding. It just needs to be profitable and running. That check is your dividend. SCHD multiplies that concept across 100 of the most stable, profitable companies in America. SCHD holds around 100 companies with long histories of not just paying dividends, but growing them year after year. Not risky startups, not trendy tech companies. Established businesses that have been making money through recessions, crashes, pandemics, and kept paying investors throughout. Every single quarter, your share of their profits gets deposited directly into your brokerage account. Up market, down market, sideways market, those payments keep coming. The numbers are compelling. SCHD pays around 3.5% yield annually. $10,000 in SCHD generates roughly $350 a year, about $87 every quarter, deposited automatically without you doing anything. Now here's where it gets powerful. Instead of spending those dividends, you reinvest them. Buy more shares. Those shares pay more dividends, which buy more shares. The cycle feeds itself and grows over time like a snowball rolling downhill. Small and slow at first, then enormous. Since launching, SCHD has delivered roughly 11 to 11.5% average annual total returns, combining price growth with dividend reinvestment. But the number I want you to remember most is this. In 2022, the S&P 500 dropped nearly 20%. Tech funds dropped 40, 50, even 60%. Years of gains disappeared in months. SCHD dropped about 3%. 3%. While the rest of the market was getting demolished, SCHD investors barely felt it. And the dividend checks kept coming every single quarter throughout the entire thing. Here's what this looks like in real life. You're 35 years old. You start putting $400 a month into SCHD, about $13 a day, the cost of lunch. You reinvest every dividend automatically. You don't panic during crashes, you just keep going. Based on historical returns, by age 55, your portfolio could be worth $350,000 to $400,000, generating over $12,000 a year, $1,000 a month, in dividend income without selling a single share. Is that full retirement on its own? Maybe not. But combined with Social Security and a 401k, that's the difference between working until 70 because you have to and retiring at 57 because you chose to. During the AI and tech boom, SCHD looked boring. People asked why settle for 11% when tech was up 60% in a year. Fair question in a bull market. But those same people watched their portfolios get cut in half in 2022. SCHD investors went through the same storm and barely got wet. Boring in the sunshine, rock solid in the rain. So here's the full picture. IAU is your fear hedge. When panic spreads, gold historically goes up. TLT is your recession play. When the economy breaks and rates fall, long bonds surge. SCHD is your income engine. It pays you every quarter, holds value during rough markets, and compounds into something that can genuinely change your financial future. 3 jobs, 3 different situations, 1 coordinated system, a simple starting framework, and this is not financial advice, just a way to think about it as a beginner. Consider roughly 50% in SCHD as your income and stability core, 25% in IAU as your fear hedge, and 25% in TLT as your recession positioning. Adjust based on your goals and comfort with risk as you learn more. The most important rule is this: stop waiting for the perfect time to invest. Nobody, not the smartest analysts on Wall Street, not the most experienced fund managers alive, can consistently predict when the market moves. There is no perfect time. There is only right now. Use dollar cost averaging instead. Pick a fixed amount you can afford every month. $25, $100, $400, whatever fits your budget, and invest that exact amount every single month no matter what the market is doing. When prices are high, your money buys fewer shares. When prices are low, it buys more. Over time, it balances out, and you build your position steadily without stress and without emotion making your decisions. That's how regular people build real wealth, not by being lucky or clever, just by showing up every month and not stopping. Now, before you click off, I want you to do something right now. Drop your ticker symbols in the comments below. Tell me what you're currently invested in. Maybe something else entirely. I want to see what you're building. And if you're not invested in anything yet, drop a 0. Just so I know you're here and you're paying attention, because awareness is step 1. And while you're down there, drop any ETFs you think deserve attention. Index funds that protect you during recessions, ETFs that pay you while the market bleeds. I always read every comment, and the best suggestions might just become the next video. Tell me how you feel about all of this. Are you nervous? Excited? Does the market feel overwhelming? Or are you starting to see it differently? Drop it below. Because here's what I've learned from this community. When you say it out loud, it becomes real. Your financial future becomes real. Now here's the most important thing I'm going to say in this entire video. Keep educating yourself every single day. Not just today, not just this week. Keep watching videos like this. Keep learning how markets move. Keep studying what happened in 2001, 2008, 2020. Keep asking questions, because the market is always going to go up and it's always going to come down. That never changes. What changes is whether you're ready for it when it does. And here's the truth that most financial content will never tell you. This is not really about numbers. It's not really about charts or graphs or ticker symbols. It's about human psychology. Everything happening in these markets is humans. Millions and millions of humans all feeling fear at the same time, all feeling greed at the same time, all reading the same headlines, all reacting to the same news. And when millions of people all move in the same direction at the same time, that is the market. That's all it is. So here's the edge that most people never find. Don't be a follower. When everyone is panicking, understand why they're panicking. When everyone is euphoric, understand why they're euphoric. Because the second you stop following the herd and start watching it from the outside, you can see where it's going before it gets there. You can position yourself before the crowd arrives. You can be already holding what everyone is about to desperately want. These people are sheep. And I don't mean that harshly. I mean it literally. When one sheep moves, they all move. When one sells, fear spreads and they all sell. When one buys, excitement spreads and they all buy. And the person standing just slightly outside that crowd, watching calmly, that person has an enormous advantage. That person is who we're trying to become together on this channel. So keep watching, keep learning, stay ahead of it, because the market will test you again. It always does. And when it does, I want you to be the calm one, the prepared one, the one who already knows exactly what to do. See you in the next one.